it's budget season again. On the 7th of November, the current government will present its national budget for 2026. With the economy showing early signs of recovery, the challenge with this budget is to maintain this growth momentum without compromising on the fiscal discipline agreed under the IMF program. Firstly, it's important to keep in mind that the government must maintain a primary expenditure at 13% of GDP under the Public Financial Management Act. That is, all expenditure excluding interest costs need to be limited to 13% of GDP. This already leaves little room for deviation from its current path. This means that in order to achieve the target of a 2.3% primary surplus, revenue should actually be over 15%. We believe this will be very possible because even in 2025, we are now on track to achieve at least 15% of GDP and managing comfortably above the revenue targets for this year as well. On the revenue side for proposals, unlike past years, no major new taxes or rate hikes are expected this time. In fact, there could be a marginal tax relief such as the removal of the Social Security Contribution Levy or the SSCL on financial services, or adjustments to VAT thresholds to ease the indirect tax burden to businesses and consumers. But even without these new taxes, revenue should stay strong. A major driver will be the continuation of vehicle imports, which has already generated significant tax inflows for this year. Collections from vehicle imports are exceeding initial targets so far and are on track to reach 700 billion rupees by year end, representing about 15% of total tax revenue. While there is likely to be a tapering off of this initial pent-up vehicle demand, these imports will help the government stay on course to meet its revenue targets for 2026. On the expenditure side, the main focus will be capital investment. We expect the government to prioritize long overdue infrastructure projects, including the Central Expressway, key urban development works, regional roads, and other infrastructure projects that will support economic growth. Altogether, capital expenditure allocation is likely to fall between 1 to 1.5 trillion rupees, somewhat similar to the 1.3 trillion allocation made for this year. Although the actual spend on this so far is expected to land at about 1 trillion rupees due to implementation delays. These projects will not only help improve transport and connectivity, but also create opportunities for local industries and contractors, giving a much needed push to economic activity. One more positive for government expenditure is that there will be an interest cost reduction coming in from the step down in the nominal coupon rate of treasury bonds held by the superannuation funds from 12% to 9% in the second half of 2026, according to the domestic debt restructure agreement. While the greater interest cost reduction will come in 2027 when the central bank holdings also sees a step down in coupon rates, the reduced stress on government borrowing from next year will help keep interest rates lower as well. So overall, the 2026 budget is likely to be positive for the economy and for the market, aiming to support citizens and businesses while keeping Sri Lanka on track with its fiscal goals. In turn, this should build investor confidence and support a continued recovery trajectory.